Theory and forecasting of exchange rates, interest rate parity, purchasing power parity and the Fisher effect. Purchasing power parity theory, PPP, explains exchange rate movements based on differences in inflation between countries. It is built on the law of one price, which states that identical goods should cost the same in different countries when expressed in a common currency. If inflation is higher in one country than another, the purchasing power of its currency will fall and the currency is expected to depreciate. PPP therefore predicts that exchange rates adjust over time to reflect relative inflation rates. Although this theory explains long-term exchange rate trends, it is less reliable for short-term forecasting because factors such as speculation, market sentiment, and government intervention can distort exchange rate movements. Interest rate parity theory, IRPT, suggests that the difference between spot and forward exchange rates is determined by the difference in interest rates between two countries. Investors seeking higher returns may move funds to countries offering higher interest rates, increasing demand for that currency. The forward exchange rate therefore adjusts to offset the interest rate differential so that arbitrage opportunities do not exist. In practical terms, IRPT is widely used in financial markets to estimate forward exchange rates. It implies that a country with higher interest rates is likely to see its currency depreciate in the future, because the higher return is offset by an expected fall in the currency's value. The International Fisher effect, IFE, links exchange rates with differences in nominal interest rates and inflation across countries. The theory states that countries with higher nominal interest rates will experience currency depreciation because these higher rates usually reflect higher expected inflation. According to the Fisher relationship, nominal interest rates equal the real interest rate plus expected inflation. If real interest rates are assumed to be similar internationally, differences in nominal rates must arise from inflation expectations. Consequently, currencies with higher expected inflation will tend to weaken over time. Together with PPP and IRP, the Fisher effect provides a theoretical framework for understanding how macroeconomic variables influence exchange rate movements.